Hi, everybody. I am Bob Iaccino from the Pure Exposure Growth Series, and you're probably wondering why I'm wearing these stupid glasses. If I pull these down, I actually can't see a thing. You can kind of see that there's these grates on the side here. These are antique welder's glasses, and the reason I have them on is because my team said, basically, if we can get 100 likes on a picture of you in those stupid glasses, that you would open the show with these stupid glasses. I had these on the shelf behind me, which you can't really see right now. And I think I've done what I said I would do with these things. Good morning. Welcome to the Pure Exposure Growth Series, sponsored by the CME Group, E-Trade. And I want to go ahead and get started. We're already 4 minutes into the 8 o'clock start time. And I want to bring in Scott Bauer, who is the president and basically the chief everything of Prosper Trading. Scott, thanks for being here again. There's a lot going on. We're not seeing a ton of market movement just yet. As I look at my screen right now, we're looking at a fairly muted open. I wanted to get you on before the open for a couple of very specific reasons. Right now, as I talk to you, it looks like we're slightly higher. S&P is slightly lower, but everything else pretty much right around that flat line. What was going on last week with the VIX? Well, I think it's really important to talk about that. We saw a spike in the VIX, and full disclosure, I am a client of Prosper Trading as well as Scott being my friend. And they did send out a VIX call spread, which I did, and it worked. It was a winning trade for me anyway. You guys sent that out, and the VIX went up Wednesday and Thursday, basically from about 2092 to about 2709. Equity markets continued to go up. Was that just not a big enough spike, or what were you seeing in that move?
No, the VIX just got down to a level as low as it's been in 6 months since March, basically. And the way the VIX works for people that they know it's the fear index, right? They hear about it all the time. It's the fear index. But what does it really measure? Well, it measures volatility in the S&P 500. And to get a reference, all right, Bob, because most people don't really know this, a VIX of, let's say, where it's trading right now, and pre-market it's trading about actually almost 25, but a VIX of 24 correlates to a move in the S&P. This is an intraday move of about 1.25% a day. Well, if you look at the moves that we've been having over the last several weeks, months or so, these moves have been well over 1% a day, intraday moves. Whether it's up and down or just up, whatever, and that correlates to higher volatility. So I wanted to put on a bullish play in the VIX, not necessarily for the reason that I thought the market was going to sell off, but because something had to converge. Either the S&P had to come down a little bit, or volatility in the S&P had to go up. And I'm glad that you followed that signal. And we still think it's going up. We still think the VIX is going to tick up, even if the market ticks up, because there's just too much headline risk. There's too much geopolitical risk, and obviously the election. So, we're still long the VIX. And again, people, know it as the fear index, but they really should understand what the VIX means. And what it is really it's measuring the percentage move, intraday move in the S&P on a daily basis.
Let me ask you, back in June, we actually had from June 5th to about June 12th, the VIX went from a low of about 2354 to about 4444. Yeah. Again, from June 5th to the 12th, which is not a big stretch of time, basically just short of doubling. And the markets were actually up at that point too. They were up for about the first 4 or 5 days of that move. And then it really took us to break out before the market would sell off. So what we saw last week was 2 days up of the VIX, 1 day up of the market, 1 day down of the market, and then the market continued higher after that, as you mentioned, the VIX settling in. Do you think if the VIX extended higher back, is it a level thing, or is it the speed of the move? Because again, in June, it took for it to get above 30, 35 before the market started to react. Do you think it's the same case here?
It's actually both, to be quite honest with you. There is a level thing. So you can look at the VIX just like you would look at any stock, right? And say, all right, we're at a support area, we're at a resistance area, but it's also speed. So when you see the vol of the VIX, the volatility of the VIX index start accelerating quickly, that's typically when we see a more rapid increase in the VIX. And, I'm looking right here right now, and futures, VIX futures right now are up almost 2 points, about 8 or 9% right now pre-market, with the market being, pretty stable. I mean, it's up a couple of hairs here. So, this to me is a precursor of either a big breakout on the upside, like where the market is expecting a big move on the upside, or we could start seeing a little bit of a pullback.
Switching gears, if I could, the dollar index is down again.
Yep.
I wanted to talk to you about that because I know you've been trading some gold lately, specifically with GLD. There's also the gold futures, both the micros, the minis and the full size at the CME. But you've been trading GLD options. Now, looking at the dollar index, we're talking about an index basically been down like 11 of the last 12 sessions, resumed a down move after a one-day recovery. What are you seeing for the dollar, and what do you see as the best way to play the dollar? Obviously, you've been trading the gold off the dollar. Is that correct to say?
Right. Absolutely. And in trading in the equity space, which is what I do on the option space, not futures, the correlation between gold and the dollar over the last several months has been almost spot on. Weaker dollar, strength in gold, vice versa. The couple times that we've seen maybe the dollar come off of those lows a little bit, we've seen some immediate declines in gold. And it has been a great trade in GLD, which is a spider gold, spider ETF that's correlated to the price of gold. So I'm still very bullish in gold. I think the dollar has a lot of headwinds on it. But what's happened is the volatility in the gold space, specifically in GLD, the implied volatility, option volatility, has gotten unbelievably expensive. Very, very expensive, because we are seeing some pretty big moves. So what I have been doing, Bob, is basically selling option premium, selling volatility, but with a bullish bias to it. So, looking for gold and GLD to continually kind of stair step higher. And that's exactly what I'm doing now again.
So that I smiled as soon as you said the volatility jump, because then I know, knowing you, I know that means you want to sell things that are expensive and then protect yourself. So what would you be looking at, let's say in the coming days? Because obviously I wanted you on before the market opened for this reason specifically. The dollar's looking again. So what are you seeing right now that you might like to actually do?
Absolutely. And I'm going to jump on this right when the market opens in about 20 minutes, if the markets stay here. In GLD, I'm looking at next week's option expiration, so September 11th expiration. And like you say, I always want to hedge myself. So what I'm looking to do is sell what's known as an iron condor. And it sounds really fancy. People get scared of option terminology, but all I'm doing really is selling a put spread and a call spread at the same time to collect really expensive premium. So what I'm looking to do, depending on probably right in here, is sell the 183, 180 put spread. So it's $3 wide to the downside. And at the same time, sell the 187, 190 call spread on the upside. Both expire next Friday, September 11th. I can, probably do that for about $1.75, maybe $1.80 or so. A massive amount of premium for that kind of move going into next week. It's a slightly bullish trade in GLD, even though I'm selling premium.
GLD looks like the pre-market's about 184, 185. So explain really quick before we have to let you go, why is this with a bullish bias?
Sure. If you look at the strikes I'm using, to the downside, my break even on this would be 181.25. To the upside, my break even is all the way up to 188.75. So I have more room to the upside to let this run than I do to the downside. That's what gives it that bullish bias.
It's about the spacing of the actual legs of the condor.
Exactly.
Scott, thank you so much, man. I want to tell people actually let you tell people where they can find you, because as I mentioned, I'm a little biased when I talk about you. So let people find you and decide for themselves. Where can they find you?
Yeah, prospertrading.com. We're out there. We help people navigate. We teach trading in these markets here, and we trade alongside everybody. And it's full disclosure, full transparency, and we're live in the markets 8:30 to 3 o'clock Central every single day.
Scott, thanks again for being here. We're going to be back with Mike Arnold, who's actually going to talk about gold and silver from a technical perspective. Pure Exposure Growth Series, sponsored by the CME Group and E-Trade. We'll be right back.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. I thought I'd start up again with these glasses on because, again, antique safety glasses. I don't know how old they are. A friend of mine, actually named Christina Fan, got these for me at some market somewhere. But our crew put a social media post up on LinkedIn with a picture of me in these glasses, and I promised I would start the show in these glasses if it got 100 likes. I think we got 101, Michael. But I want to welcome in Mike Arnold, who is the Chief Technical Officer at Path Trading Partners. He's also a co-founder, and he is also a co-portfolio manager for the stock think tank, which sends out daily stock picks for the sort of active, medium-term active investors, stockthinktank.com. Mike, thank you for being here. I want to get you going right away on your charts, because that's what you do. You're a technical guy. And so am I for the most part, but full disclosure, Mike and I work together on a lot of things. And when I have a fundamental opinion, Mike is required to, if necessary, veto me if the charts don't match what I'm thinking from a fundamental perspective. So Mike, thanks for being here again. Let's jump right into the NASDAQ. You've got an NQ weekly chart that we want to look at. What are you seeing? And again, thanks for being here, but what are you seeing on this NASDAQ weekly chart?
Good morning, Bob. Great to be here. NASDAQ weekly chart, the NQ, as you said, we have a massive, massive rising wedge formation, which is a bearish formation and could be a potential reversal. Now, I say could be because this NASDAQ keeps, as long as with the S&P, keeps just marching higher. Before I get into the reversal pattern, which actually, if it does trigger, we need, at this point, if we got a close below last week's low, it looks like it would trigger. And this pattern is challenging because it actually, every day we progress, and if the NASDAQ goes higher, it actually changes the trigger point. But right now, virtually, if you got below last week's low with a closing price, it would trigger. And it could at least lead to a 10% sell-off. Now, we're not trying to predict anything as a trade and not predicting. So I actually have still targets to the upside. Our next targets to the upside in the NASDAQ are 2165 to 2196 little cluster target range, and then 12,346 and 25 cents, not to be exact. What's also interesting with the NASDAQ is we are running out of momentum. We have divergence after divergence setting up. So this is waiting momentum to the upside. Not saying it can't go higher. We still have higher price targets, but we are watching for that potential reversal.
So I'm sorry, go ahead.
I'm going to say the same. We are getting waning momentum. If you call up the S&P weekly chart, also that's the ES weekly chart. We also still have some upside targets of 35.30 and major target of 35.50, and nothing really above 35.50 at this point because we haven't had enough back and forth price action. We actually haven't had enough selling pressure in the market for us to generate new signals. The roar to risk. Now, I'm not saying these things can't go higher because they will keep going higher until they don't. The problem is the upside, all our models are showing we can have some upside potential, but the amount of risk you're taking for that upside potential is so skewed to the risk side. You might eke out 1 or 2 more percentage points the upside, but you're taking on over 12% risk to the downside potentially. There's not a guarantee that has to happen, but when the models get that skewed, for every dollar you're investing, you're looking to get that 1 to 2% return, which would be 1 to 2 cents for a dollar, but you're risking over 12 cents. So that's where it gets really challenging in this environment.
Is it safe to say that this is actually sort of I mean, you've been seeing warning signals for a long time about the potential downside. Yet, like the stock think tank is invested. So is that why, specifically in the stock think tank, you're always taking profits and kind of re-upping on things whose risk reward may have adjusted? But when you see this kind of divergence, like advanced decline divergence, for example, does that make it harder to find the stocks you want to be in?
Well, a lot of this market's being driven by a handful of stocks. So there still are some good stock plays. But again, if we have a major reversal, it's going to drag down even the good stock plays. So when we find a good stock, we find a good entry, okay, it's then aggressively, as it does rally, move up the stops, and when it hits certain technical patterns, take the profits, because we don't want to leave a huge amount of risk in the markets. So we still have to trade, we still have to participate, and there are still participation opportunities available in certain stocks, but it's not something to just sit on your hands. It has to be actively managed every day because, again, we're not predicting a reversal, but the conditions are set up to where we could have a significant reversal. So when that happens, we will aggressively remove positions and initiate some short positions or some downside protection. But until then, we have to keep trading from the long side.
So that actually brings up something interesting to me. The dollar itself, as I was just talking to Scott Bauer about, is basically it's down like 11 of the last 12 sessions, 12 of the last 13 sessions, something to that effect. But how do you make sense of a chart like that, given that when you're looking at least lately, let's call it over the last 3 months or so, a weak dollar's basically been good for every single asset class other than the dollar. So how are you looking at the dollar index right now? We've got a DX daily chart, I think.
Yeah, on the DX daily chart, we actually have major waning downside momentum. So it's running severely out of momentum. From my own personal point of view, we're watching for a long trade in the dollar index futures. And if you're playing it with stocks, there's a UUP. It's called UUP. There'll be a really nice trade in that. We can still potentially make new lows, which I'd love from a technical standpoint, because then we get a triple divergence pattern with potential lows at 91.87 and 91.64. If we can get spikes down to those levels and then a significant reversal, that will trigger a long dollar trade, which could tie into a sell-off in the markets. Again, not trying to predict, but we're watching these because of the waning momentum. And everybody's saying, well, I hear two camps. So either the dollar's just going to take another major move down, which would be fine with me because it actually strengthens the bullish case, or we're just going to have a massive dollar rally because it's oversold. I'm somewhere in the middle with we're watching for that setup and we need that key reversal. And then my levels, if we get above 93.50 on the dollar index, we're then looking, funny enough, the levels come out to 94.01 and then 94.50 or 94.52 are my exact levels on any upside trade. And that's on the dollar index.
So that's more of like a correction or sort of like an easing of the pressure on the dollar. It's not a change in trend.
No, it's not necessarily a change in trend. It's just getting out of this massively oversold condition and getting to a new corrective place where we then might look to, again, put on a dollar short. But right now, the downside rewards do not justify the reversal risks. There's more potential strength to the upside than downside at this moment.
That's a great way to wrap that up. And I'm going to be talking to Jimmy Iurio about the indexes. So make sure you guys remember the levels that Mike was talking about there. But I want to get to the precious metals, Mike, because we talked to Scott Bauer about those as well. Scott has been trading GLD in and out on the options side. He said the volatility's high. You've got both gold weekly and daily to talk about and silver weekly and daily to talk about. So let's make sure we get those in.
Yeah, with gold weekly, GC, the weekly chart, we're looking at October right now, the futures. What was really nice, we were in gold via GLD, the ETF, in the stock think tank, and we got out because we got a lot of reversal signals. And if you look at that weekly chart, we did get the nice reset pattern back to the weekly rotation zone. We actually pulled back 25%, over 25%, but we were watching that 25% level with the rising rotation zone, and we got back to those levels. And now we're watching for, if you go to that gold daily chart, I have one of our nice best fit lines on there, and we're watching for a key close, especially about above 2,000 again. A key close above 2,000. We're targeting 2,032, 2,051, and 2,096 to the upside, and that doesn't even take us to recent highs. It just is a short. Now we might run into highs again, and we're looking for that, but we have some intermediate term profit targets to trade in and out of. We've just got the reset pattern, which means we've reset the overbought condition on the weekly basis. So these now are aggressive daily plays to go into there. Silver, on the other hand, SI, the futures also, which we're watching October, on the weekly basis, we have not yet reset the weekly pattern. Now, silver's actually performing a bit better than gold, but there's more risk still to the downside. So that is a more aggressive play. If you look at that weekly chart, when I say the weekly rotation zone, I'm looking for a reconnect with that rising orange line. Right now it's trading about 25.56. That would reset it and give us a more bullish perspective on silver. But it's actually moving up nicely above our path trading trend line today. And if we get a close, let me give you the exact number, above 28.1950, so 28.20 would trigger a potential long trade in silver with some targets around $29.40, $30.02, and then if we go off to make new highs, $30.99 to the upside. So there are precious metal trades which still have decent reward to risk. Silver is riskier than gold. And, we're going to have to see how all this plays out, especially if that dollar triggers long with these precious metals, because it'd be very interesting if we get long trades in precious metals and the dollar at the same time, which traditionally does not normally happen.
What was that silver entry trigger again? And I'm not saying people keep this trade, but we might.
That silver entry was a close above 28.20 on the October futures.
Where can people find you, Mike, if they want to talk to you or if they want to talk about the stuff?
Reach out on Path Trading Partners. They can reach me at support at Path Trading Partners. Also, great way to find me is on the YouTube channel, Path Trading Partners YouTuber. We put up videos every day, and we even take user requests. If you want me to analyze a market, you can put it in the comments. You can email me, and we'll put it in the queue to analyze some markets for our viewers and subscribers for free.
Mike, thanks for being here, although you're my partner, so you don't really have a choice. Guys, Mike, Arnold, I want to get back to our sponsors, E-Trade CME Group. Then we'll come back with Jim Iurio, who's going to be talking about putting a trade on in one of the new CME products that we really like. We'll be right back. Don't go anywhere.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
Jim Iurio, and I'm wearing these stupid glasses again. I think maybe this is the last time I'm going to do this. I got Kilberg coming up later. I don't even want to give him the opportunity to see these glasses. But again, our crew here at Pure Exposure looking for 100 likes. I think it was on LinkedIn. I don't know. I don't pay much attention to social media. Antique safety glasses for a welder. When I put these down, I can't even see anything. Like, I literally can't see anything. But I'm going to take these off and welcome Jim Iurio is Managing Director at TJM Institutional Services. Jimmy, looks like you're back in the office.
Well, I'm back in an office. Let's just say that I'm back on the trading floor, actually. But so
that's good. I can see glass there. You're all protected. Let's get right into this because I wanted to have you on for right around the open, which right now is looking fairly flat. I mean, we've got the Russell down about 22 basis points in the futures. We've got the Dow down about 16 basis points. Looking at my E-Trade platform here. S&P looks like it's right around the flat line. NASDAQ looks like it's just slightly higher by about 19 basis points. Commodities are stronger. Copper is up. What are you looking at? And then I want to ask you a couple of specific questions about some of the things we talked about today.
Okay, well, the fundamental story was absolutely reinforced at the end of last week. We had Thursday coming out. Jay Powell came out and basically said they are so all in on inflation and they're going to let things run hot, which is kind of what we expected, but it's still just kind of amazing to hear him say it out loud that they changed everything. Then we have Abe retiring in Japan. Remember, Abe was the guy who almost invented the just depress your currency as quickly as possible. In 2012, he was the guy who knocked the yen down 13%. So, him being gone also seems a little dollar negative as well. So to me, that, definitely emboldened me with all the commodities you're talking about. I'm long gold, silver, I'm long crude, I'm long S&P, and I'm long NASDAQ. It's kind of the long everything trade because of this fundamental story. But at the end of the day, technicals are more important than fundamentals. And Mike Arnold was just talking about that a second ago too. If things price everything in and it's time for a market shakeout of the weak hands, that could easily happen. Because just because the fundamental story keeps getting better and better for those things doesn't mean it's not a two-sided trade. So I'm being somewhat cautious as usual.
So I love that actually technicals are more important than fundamentals because I believe in that as well. I don't believe one is unimportant, but it's very similar to like when the way that I look at it, when you look at a chart, you're seeing four things. You're seeing the open, the high, the low, and the close. And to me, the close is always the most important thing of those four things. So things have a value. And I'll give you an example. We bought Walmart at about 131, okay? It went down to about 128. Mike's technicals told us that trade was not incorrect until it got through 127. And then obviously with the TikTok news, we got out at 141. We made about $10 on that per share in a stock think tank. Now, the reason I bring that up is we had no idea that Walmart was going to be involved with TikTok. There was just a pattern. So I think that's sort of what you're referring to, right? It wasn't a fundamental trade for us.
No doubt about it. And I'm even referring to more than that. As when I look at a chart too, in my mind, the market has already digested all the fundamental news. By the time we're hearing it, we know there's the myth of smart money, and I believe in it. And I think it's psychology, it's momentum. It's what a market is primed to do at any one spot. I still argue that when the pandemic began to happen in earnest in March, one of the things that was truly, truly unfortunate is that the stock market was overbought. Volatility was extremely low. We were at all-time highs, and that, I think, exacerbated the 36 to 40% move on the downside, more so than even the story. Now, the story eventually changed into a pretty dire story for the economy, but it was also coupled with Fed accommodation, which to me, the stock market didn't necessarily have to break that far, but the technicals pushed it.
Jimmy, can I ask you about the VIX? You're obviously very big in the indices. You're very big in the interest rates. Watch volatility, probably closer than anybody I know. The VIX went up on Wednesday and Thursday. Stocks went up on Wednesday, but not on Thursday. We saw a similar move in June where the VIX almost doubled. It was like June 5th to June 12th. And it took 4 or 5 days before the stock market reacted. Is there an area of the VIX you're looking at, or is it a speed of the move of the VIX that you look at it before you start to worry about it?
This is funny because I talked to some people who worry about the fact when the VIX and stocks rally together. The VIX is in the mid-20s right now, historically a relatively reasonable, even almost high level. To me, it seems when the VIX is rallying along with stocks and worry it seems to me to be picking up and people are using options to hedge positions, that to me makes me a little more relaxed. What worries me much more is when the VIX cracks 14 on the downside, and it seems like no one gives like, can I swear on your show? Every word I thought of after gives was, but anyway, no one seems to give a care that the market is going higher. So, yeah, what's that?
I don't give a shit if you swear. So.
Oh, good. Okay, good. So we have the green light. Yeah. So nobody seemed to give a crap that that the market's going higher when the VIX is at 13. When I see the VIX in the mid 20s, I'm a little bit more emboldened to the upside, not the downside.
That's interesting. So, are you bullish now, and what's the trade you're looking at specifically?
I'm bullish. I'm getting more and more bullish as if the markets can stay above 35.10, which is not actually there right now. The trade I'm looking at specifically, and mostly, you know, I trade a lot of the ES options. And this is a trade example in the micros. I actually haven't used the micros yet because I'm using still the regular ES because, I mean, they serve an unbelievably good purpose for putting on really minute and precise trades. But here's the trade I'm looking at. Buying the week 2 micro, the new options contract CME on the ES, is the 35.50, 35.75 call spread to sell the week 2 micro, 35.50, 35.25 put spread. So you're selling a put spread to help you pay for a call spread. When I priced it up, the market was trading about 35.11. So at the time you pay 3.5 ticks for it. So what you end up risking is $145 to make a potential $107.5. And some people may look at that and say, well, no, the risk reward is skewed, but the risk reward is priced that way because the downside, the top strike and the put spread was 1.8% away from the market. The top strike in the put spread and the lower strike in the call spread, where you start making money, was only 1.1% on the upside. Plus, the momentum by pretty much anyone's measure is still, you know, moving higher. And until it proves otherwise, to me, I still think the trade's that way. And one of the reasons I really like this is that it defines your risk. Instead of just buying futures, where you essentially have unlimited risk on the downside, when you use this kind of trading option, it's a relatively aggressive trade and will get more aggressive as things start to rally, but you're defining your risk on the downside.
Well, 2 quick questions. You said you haven't used the micros. You've used the micro futures. You just haven't.
Oh, all the time. Yeah, I haven't used the micro options yet. They just launched last night. I'll probably use them before the day's end just to see what the liquidity is like for future reference stuff. I use micro futures all the time. I use them to hedge options positions. I think that they're a beautiful addition to the toolbox.
Yeah, one of the things I really like about the micros, and you mentioned it, is the minute detail that you can get down to. Similar to the only reason I like the Apple and Tesla split is now if I was going to buy 2 shares because I needed to buy 1.7 shares, I can actually go down and buy 7 shares instead of the 2.
Yeah, and the micro too. Like sometimes you have to realize that sometimes you have strong feeling, medium feelings about a certain trade, and sometimes if you don't want to worry about it and stay up all night, you throw a couple of micros on instead of the big, so you're not risking a couple grand overnight. To me, I love that.
So, last question for you, if I could, from a perspective of the trade you mentioned. First, it was buying the week 2 35.50, 35.75 call spread, and selling the week 2 34.50, 34.25 put spread. I'm looking at the S&P a little bit lower than where you priced it out. Number one, does that make it more expensive? And number two, as you mentioned, the 1.8% to the downside, it's a tougher ask for it to get you a put spread, is why you have the skewed risk reward.
Right. So now when I just looked at the S&P and I haven't looked at where this trade's priced, it's trading right around 35, even the buck now, which would make it the exact same percentage on both sides. In a situation like that, you would expect the call spread to be a little bit more because of the skew in the put spread. So you'd still probably pay, but you're going to pay much less than the 3.5 ticks I was looking to pay. Probably right now, and it's just a guess, it's probably 1.5 ticks to buy call spread.
Jimmy, you're super active on Twitter. Can you give everyone your Twitter handle, please, so they know how to communicate with you?
At Jim Iurio, which is JIMIUORIO.
Anything you want me to tell Kilbert when he's on?
No, just that I'm smarter than him, and it's finally time that he should admit it. Okay?
I will let him know that, buddy. I
Okay,
appreciate
good.
it. On again. Go ahead and give Jimmy a follow, because I'm telling you, his Twitter is informative and amusing. We're going to be right back. Thanks again, Jimmy. And we're going to be right back with the rest of the Pure Exposure Growth Series. We've got John Still from Acorn Wealth Management on next to him. Super excited about. I've got a ton to go over with John. So stay with us. We'll be right back after a message from our sponsors, E-Trade and the CME Group.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
G'day. Can you hear me loud and clear?
Yep, we're gonna go on right now.
We are back again. I'm wearing these silly glasses again because the posse here at Pure Exposure Growth Series put up a social media and basically said that I needed to wear these if we got 100 likes on it. So, John, I didn't want you to miss seeing me in these stupid antique safety glasses. I'm going to take them off again. John Seville, Wealth Management, is joining us. John, where are you at right now? Because you're kind of a world traveler trader.
It's funny you ask. I'm actually sitting in our RV. We're RVing across Canada. We're in the Jasper National Park right now.
Always somewhere. I try to reach out to him to get to him on the show, and I usually hear back from him within a couple of days. Telling me
Actually,
that.
there we go.
Fantastic. Let's get to the markets, man. You and I have got a lot to cover. You're 95% long right now in your short-term portfolio. Let me just give you about 2 minutes.
In our RV, we're RVing across Canada.
Can you hear me, John?
Yes. Sorry, go ahead. 2 minutes on.
Yeah, go ahead and just give me 2 minutes on your whole thesis as to what you're looking at in the market, because you're 95% long in your short-term portfolio. So I want to hear why that is.
Sure. I mean, at Acorn, we place a large degree of focus on the price action and the patterns that are going on in the market, as well as following where the smart money is going. When we're looking at the way that the S&P 500 has been going since the lows of March, well, firstly, we had a record amount of insider buying in the lows of March. We had more buying than we'd seen since the lows of 2008 and 2009. I think $1.6 billion worth of insiders purchased stock in their own companies in March of this year. So ever since then, with the S&P 500, we felt has been maintaining a momentum trend, holding its moving average as well, respecting that momentum. And while it remains above both its 9 and 20-day daily moving averages, we're still seeing that momentum continue. High yield bonds have continued to rally, showing the support and the buying from the Fed. And we're also seeing most importantly, that the price action across those indexes still push. Russell 2000 just broke out of a downward channel on the hourly chart over the last few days. So we're still seeing a lot of technical reasons for the indexes to continue higher. However, with that being said, we are starting to see some divergences, which are keeping us on a week-to-week basis as to how long we continue to hold those positions.
I think that's important, right? That we see some broadening of the rally when you mentioned the Russell. I've been on TV several times in the last few weeks saying that I want to see the Russell lead and still see the NASDAQ up. Now, but the breadth of the market is not really cooperating. So is that why you'd rather, is it sort of, you look at insider activity quite a bit. Is that like the internals of a company's breadth, sort of like the market breadth, or is it different?
Yeah, I think especially in today's economy, that we're dealing with a market that is going up, but that doesn't necessarily mean that all stocks are going up, and we've certainly seen that recently. I think we had in the highs of June, we had close to 92% of stocks across the entire market were above their 50-day moving average. However, as the market has broken, whereas the S&P has broken record highs, we've seen the amount of individual stocks still holding above those levels decline, which is very similar to what we saw back in 2018. It's the same thing that we saw prior to the 2020 crash. So when we're looking for the gems of where we feel safe, still holding long in a market that we're concerned about, we are looking for those for some level of insight that those individual stocks have some alpha that they can. That would we feel comfortable holding them if we felt a 5% pullback was coming in the index? So yes, we're certainly looking for that. That exposure to some breadth in the company. That look, if we're for example, when oil crashed, what kind of oil stocks will we be looking for that could present the strongest recovery? Well, we want to look for the ones where we can see considerable amounts of insider buying after the crash had happened, so that we can assume that you'd assume they're not about to announce bankruptcy a few weeks later when you see that kind of insider activity.
One of the things I like about what you do is you sort of put that model on both sides of the market. So you've got longs that you like right now, but you've also got shorts based on that same methodology. So what are a couple of the specific policies that you're looking for, sort of medium term?
On the long side or the short side? Sorry, Bob.
Start whichever one you want.
Sure. Well, I think that there's one stock that we're looking at the moment is GCI, Golf Charlie India. And this is coming into your kind of small cap area of the market, small to mid cap area of the market. I mean, these guys are the owners of USA Today. They're a media company, and they obviously took quite a hit in the decline. And if you can see over the last 6 months, they've declined all the way down to I think around about $1.20 is the lows they got down to, but. This is quite an interesting stock for me because it falls into the type of pattern that we really like to focus on, which is something that has had a considerable drop. So we've got some value-based buying opportunity here, and we're seeing a momentum consolidation at the bottom, and that's really the key. Is we want to see that more momentum side of the price action versus more of the oscillation you sometimes see in other stocks. So GCI falls into that category. We've had a nice momentum base since the early April, and we're just starting to break out through those that moving average system over the last 2 weeks, forming almost a little bit of a cup and handle type of formation. So from a pattern perspective, that offers a lot of upside and momentum to continue pushing to the upside. From the inside perspective, they've had quite a few transactions recently. Their director, Maria Miller, actually purchased in March, and although it was only a few $100,000 that she purchased, what was more interesting to me was the level of conviction in the buy, because the purchase that she had made in March represented a 320% increase in her reported position. We also had Kevin Sheehan purchase around the same time, which is another director on the board, which had also purchased a similar dollar amount, again not in the millions, but more importantly to me was the level of conviction, because it represents a 104% increase in his position. You've also then got Michael Reed, the CEO, who had actually purchased late last year, picked up about $4 million worth across 2 transactions, and that was between the $6 to $9 amount. And of course, we're trading down currently today at $1.81. So assumably, the CEO sees value at 6, and since the market decline, we're now trading at 1, so 180. So that's one idea that we are already holding long. But if we start to see a breakout above 223, that's something I'll look to add to that position as a kind of fallen angel, if you will. That's one of the top longs.
Let's get these next 3 in. We've got about 3.5 minutes left. So I'm very familiar actually with Silica Holdings because of my dealings in the energy space. So what do you like about them? And then throw out the 2 shorts really quick if you could.
Well, yeah. SLCA or silica is probably a forward-looking version of what we're expecting from GCI. Very similar approach in how we found it. Looking for that stock that had a significant decline. Of course, we had from the August highs of last year with $15. We came all the way down to 65 cents, and once again formed that lovely momentum base and that kind of same swoop back up that we're looking at in the GCI chart. SLCA has had a lovely run from $2 where we first found it at, now at 456. From a technical perspective, if we break above 5, I think that there's really little holding this back from a technical perspective, and there's a lot of momentum behind there. Again, you've got broad spread insider buying across the board of directors, not as big percentage-wise as some of the transactions in the previous company, but it's broad spread. We've got 5 or 6 directors all buying in the last couple of months, so including the CEO, senior vice president, and other various directors as well. So that, I think, from a technical perspective, as well as from an insider looking perspective, SLCA looks strong.
Real quick, throw me the 2 tickers out for the shorts. Unfortunately, we run out of time to let you go through them, but throw out the 2 ticker symbols and where people can find you if they want to know about these 2 shorts, because I think that's almost as valuable as you going through it. Sure.
The 2 shorts, one of which we're already in and one we're looking to get into in the next few days. So the first one that we're already in is EXAS. That's Echo X-Ray Alpha Sierra. We're already holding put options in this. Counter trend to the index direction, looking really good. The other one we're looking at is ENPH. Echo Nancy Papa Hotel, and this is in a rising wedge that's looking like it could be ready to really break down. Insider selling as well. So yeah, if people would like to actually follow along with those ideas, they can check us out and even take a trial of our alerts by going to www.smartmoneytrading.com.
Great. So smartmoneytrading.com. Talk to John. John Seville, thank you again for being here. We're going to come back after this message again from our sponsors, E-Trade and CME Group. I think they're only about 60, 90 seconds. Stay tuned for Jeff Kilberg, who's the CEO of KKM Financial, CNBC contributor. We're going to be talking to him about specific sectors and ETFs. John, thanks for being here again, and we will be right back.
My pleasure.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. Bob Iaccino from the Pure Exposure Growth Series. And again, I'm wearing these goofy glasses. If you didn't check us out, you can find me on LinkedIn and see the original picture of this. These are antique safety glasses that a friend of mine got. On the right, yeah, a friend of mine got for me at some antique market. And I keep them near my trading desk. You can't really see anything when you put these purple lenses down, but I keep them near the trading desk to remind me that there's actually real work that other people do versus what I do here at Pure Exposure and with our trading. We do quite a bit of research, but I'm constantly sitting in this chair rather than doing actual physical work. We are waiting on Jeff Kilberg to join the meeting. Jeff is the founder and the CEO of KKM Financial. So let's give you some market updates. While we're doing that, we're looking at the NASDAQ right now, which is leading, which we don't love to see. The NASDAQ is up about 46 basis points. The Russell's actually down about 59 basis points. And that's the mix that we don't really like to see, right? Because we want to see the broadening of the rally between the NASDAQ and the Russell. The S&P right now down 11 basis points. And what did I say? The S&P? Yeah, the S&P is down about 11 basis points, and the Dow Jones itself down about 50. And I'm just trying to get this sorted. So looking at the stocks that John just talked about, that end phase energy is interesting to me because it's very similar to the rising wedge that Mike Arnold talked about in his analysis of both the S&P, the NASDAQ, the Russell, et cetera. So looking at it from that perspective, if those were to break out of their rising wedges and go down those lower levels, that doesn't mean it's necessarily a long-term short. And that's one of the things. When you're shorting individual stocks, you have to make sure that the stock's easy to borrow. That's a difficult thing, and sometimes shorting is difficult for individual traders. So as John mentioned, he does this in options. That's also something that Scott Bauer talks about quite a bit, is doing puts and calls and the like, as opposed to doing actual equities. So when you're looking at it from a perspective of the equity problem of shorting, that's what the options are all about. And I talked to Jimmy about the micro futures. I want to touch on those. The micro futures have been around for quite a while now. Last May that they launched. It became one of the most successful products at the CME Group. They're 1/10 the size of the mini S&P. So as Jimmy mentioned, you're able to put on trades overnight, one of the micros, two of the micros, and take advantage of moves that won't crush you if you're wrong from a perspective of risk. Obviously, everybody's got a different risk perspective, okay? But they also are a way to kind of keep active in the markets and get involved in ways that you otherwise couldn't. Now, the CME Group has launched micro options. So again, it's 1/10 the size of the regular size contract. So now you can dial down in calls and puts, call spreads, put spreads, some of the condors and things that Jimmy talks about that Scott Bauer does in the cash markets, right? All those things involved in the micro, doing those in the micro options at the CME Group. By the way, if you have an E-Trade account, you can do those through your E-Trade account. Make sure you reach out to your rep there, have them enable your account for futures. They'll walk you through the process of doing those things. E-Trade has quite a bit of help for their clients if you're not familiar with it. And then the CME Group itself, I want you to go to CME Group Active Trader and follow that on Twitter. You'll see me there all the time. If you can't find it, go to Bob_Iaccino on Twitter. I'm constantly retweeting at least things that I'm involved in on the active trader side for the CME Group. And then you can find all the educational stuff that they have on the micros. So from that perspective, looks like we're getting Jeff Kilberg in here right now. Let me talk about my relationship with Jeff, because I've known Jeff for quite a while. And I mentioned that CME Active Trader thing, they have a show called Striking Options. And Jeff is the host of the Striking Options show. And every week, Scott Bauer and I alternate being the guests on that Striking Options show. We actually give these options examples. So if you want specific, we'll call them examples because they're not trade recommendations. If you want specific trade recommendations on the micro options, we're likely to be covering that in the Striking Options show, which again, you could find at that CME Group Active Trader website and Twitter. So from that point, Jesus, do you see him in there? There he is. All right, looks like we're having technical problems with Jeff. Give me one more second to see if I can get him loaded. Otherwise, we're going to wrap the show up because we're running out of time anyway. I really wanted to talk to Jeff about a theory that I have. Financials themselves have been getting beat up in the U.S. If you look at the XLF, okay, the XLF is the financial sector spider, okay? That has been getting really beat up. It's not been performing well, and we actually have a steepening of yield curve, which should be good for the XLF. My question and my theory is Warren Buffett just made a substantial investment in billions of dollars in Japanese financial firms. So wondering now, and it's a thesis, okay, so we're not getting a signal in the XLF at this point. It's just that signal that Warren Buffett thinks there's an opportunity in financials and that the US financials have maybe gone a little too far. I don't know if that's what he thinks or not. Moving into the Japanese financials, instead of buying the XLF, he's already got a huge position in Bank of America. He exited most of his position with Wells Fargo and some of the other major money center banks. He's still got that big Bank of America position. So I'm not sure if that's what that means. And I think looking at the XLF is something that I'm going to ask Mike Arnold to do for the Stock Think Tank to see if there is some, I don't know, maybe way to play this where the XLF might start recovering. We got the steepening yield curve, which is good for financials. And then again, this Buffett investment might be a sign that at least globally, there's some way to move forward with financials. It might be just signaling that US financials were either too expensive, that's the positive side of it, or too risky, that's the negative side of it. So that's my thesis on that. We're going to go ahead and end the show on that. I'm sorry we couldn't get Jeff on, but we'll try and get Jeff on the next show. Full disclosure, I actually sent Jeff the wrong time originally in the setup email. So I had to panic and kind of reach out to him and get him in there. But we're not able to get him in. We're going to go ahead and end the show. Pure Exposure Growth Series sponsored by the CME Group and E-Trade. You have just been exposed. Thanks for being here.